Hello everyone, my name is Krystian Cieplucha, financial consultant with Alliant Retirement and Investment Services. Welcome to our presentation regarding college savings planning. What we'd like to do today is offer you a helpful information guide about how to save for college. You'll be seeing information about current and future expenses. We'll go into detail about ways in which you can save for all those different costs. And you'll learn about different things like Section 529 plans, Coverdell accounts, and other methods of paying for college. It's rare to pick up the newspaper or magazine without seeing an article about the increasing costs of going to college. When you add up tuition, room and board, books, and other expenses, the total cost of a year at a public or private college may seem like a lot, and because it's a major financial investment. The College Board, a not-for-profit organization whose mission is to connect students to college opportunity and success, is a key resource for college planning. In its 2022 report, Trends in College Pricing and Student Age, the College Board reports that a moderate college budget for an in-state student attending a four-year public college in 2022-2023 averages about $28,000. For out-of-state students at public colleges, the average budget comes to just over $45,000. And for students attending private colleges, the average budget is $57,570. One popular way to save for college is to use what's known as a 529 plan. These include basic savings plans and prepaid tuition plans. There's also Coverdell education savings accounts, which are another popular method of putting aside money for college. And you may not have realized it, but U.S. savings bonds can also play a role. Then there's Uniform Gifts to Minors Act and the Uniform Transfer to Minors Acts, which are arrangements which have been used to pay for college expenses for many years. Another way to pay for higher education is through student loans, and we'll also look at a couple of different options. So first I want to talk about Section 529 plans. A 529 plan is an education savings plan operated by a state designed to help families set aside funds for future college expenses. It's named after Section 529 of the IRS Code, which created these types of savings plans. 529 plans are established by the states. Except for Wyoming, all states offer at least one 529 plan. Anyone can establish a 529 plan account, be it a parent, grandparent, or friend, and you can invest in the 529 of another state. The beneficiary can be anyone. The only requirement is that the person be a U.S. citizen. There are two types of 529 plans. There's a savings plan, which works much like a 401k or IRA by investing your contributions in mutual funds or other investments. Your account will go up and down in value based on performance. And then there are prepaid plans that prepay all or part of the costs of an in-state public college education. They also may be converted for use at private and out-of-state colleges. While 22 states once offered prepaid tuition plans, there's only 9 that do so today. And that's Florida, Maryland, Massachusetts, Michigan, Mississippi, Nevada, Pennsylvania, Texas, and Washington. This is mostly due to the rising cost of tuition, state funding shortages, and other economic circumstances. The person who opens up the account, not the beneficiary, owns the account and retains control at all times. He or she decides how to invest the money that is contributed, how withdrawals can be used, and also the beneficiary. Unlike Roth IRAs and Coverdell education savings accounts, 529 plans have no income limits. There's no age limits, neither are there any contribution limits. Initial minimum contributions often can start as low as $25, and then monthly contributions can be as low as $15 in some states. Most plans allow you to set it and forget it with automatic investments that link to your bank account or your payroll deduction plan. There are lifetime contribution limits to keep in mind, which vary by plan. They range from $235,000 to $550,000. For most people, estate and gift taxes are not really major issues. Contributions qualify for the federal annual gift tax exclusion. If you make contributions greater than that exclusion, you would probably not have any gift tax liability because you would be able to use up your federal estate tax exclusion before you would owe any gift taxes. In any event, it's always smart to check with your tax advisor about any estate or gift tax consequences in contributing with a 529 plan. So contributions to a 529 plan are made with after-tax dollars. Although those contributions are not deductible, earnings in a 529 plan will grow federal tax-free and will not be taxed when the money is taken out to pay for college. In addition to the 529 federal tax benefit, over 30 states and the District of Columbia currently offer a full or partial tax deduction or a tax credit for a 529 plan contribution. In some cases, the 529 contribution reduces taxable income as far as your state taxes are concerned. You need to check with your state to see if your contributions qualify. And then withdrawals have two parts. There's the contributions and the earnings. If a withdrawal is taken for a non-qualified expense, the earnings portion will be subject to federal and possibly state income tax. Also, the earnings portion of the withdrawals taken for non-qualified expenses may be subject to a federal penalty of 10%. There also may be state income tax penalties to keep in mind. So qualified expenses include tuition, fees, books, supplies and equipment, and room and board at eligible higher education institutions. While many parents plan to use 529 money for college, these funds can help pay for other education expenses as well. Tax-free withdrawals may include up to $10,000 in expenses for private, public, or religious elementary and secondary school educations. That's per year per beneficiary. You can also withdraw up to $10,000 for student loan payments per beneficiary and per sibling, also step siblings. The cost of apprenticeship programs are also now considered qualified education expenses, so you can use 529 tax funds, tax-free funds to put towards any of these programs. Eligible institutions include virtually all accredited 2- and 4-year public and private colleges and universities in the United States, as well as some vocational schools. They also include a number of colleges and universities outside of the United States. I'd also like to point out a recent new benefit of 529 plans, which is effective January 1st, 2024. The Secure 2.0 Act of 2022 made it possible to roll 529 funds to a Roth IRA without incurring penalties or taxes. The lifetime rollover limit is $35,000, but the contributions for 2023 are subject to annual IRA limits. The 529 must have also been open for more than 15 years. There may be lots of tax advantages to using your state's plan, such as tax deductibility or contributions and/or tax breaks for qualified withdrawals. The tax features alone might make your state's plan appealing, but you should check other states' plans as well. These are some important factors or questions to consider as you do your research. Number 1, are there state tax benefits for residents or negative tax consequences for non-residents? Number 2, what investment options are available? How much investment flexibility is offered? What are the fees? Thirdly, what are the minimum and maximum allowable contribution amounts? Also, are there restrictions on who can be a beneficiary, and can a beneficiary change be made? What are the options for account access, whether by customer service representative, phone, online, etc.? And lastly, what is the process for making withdrawals? Is it paper documentation that's required? Can payments be sent directly from the plan account to the college? All of these are important questions. Now let's talk about Coverdell Education Savings Accounts. The Coverdell Education Savings Account, ESA, is a tax-preferred savings and investment account authorized by Internal Revenue Code to encourage people to save for future education costs. They used to be known as education IRAs. The Coverdell Education Savings Account became a very attractive college savings vehicle for many people, including families that wish to save for elementary and secondary school expenses, as certain K-12 expenses were added to the list of qualified expenses. In fact, even if you like the 529, you may still decide to contribute the first $2,000 of savings for each child into a Coverdell account. There are some items to be aware of, such as the following. The beneficiary of the Coverdell ESA must be under the age of 18 at the time the account is established. The contribution limit is $2,000. However, you need to be careful when the accounts are established by different family members for the same child. If total contributions exceed $2,000 in a year, there could be a tax penalty. The relatively low contribution limit means that even a small annual maintenance fee charged by the financial institution holding your ESA could affect your overall investment return. Your contribution goes into an account that will eventually be distributed to your child if not used for college. You cannot simply refund the account back to yourself like you can with most 529 plans. This means you do lose some degree of control. The ESA is on equal footing with the 529 plan when applying for financial aid through federal sources. The account is considered an asset of the account custodian, typically the parent. Withdrawals are not reported as student or parent income as long as it is tax-free for federal income tax purposes. Coordinating withdrawals with other tax benefits, especially the HOPE or lifetime learning credits, can be a little bit tricky. So keep in mind again, the account must be fully withdrawn by the time the beneficiary reaches age 30 or else will be subject to taxes and penalties. Earnings in the ESA are tax deferred, just like Section 529 plans. Similarly, if withdrawals are used for qualified education expenses, as defined by IRS Internal Revenue Service, they are exempt from federal income taxes. If a withdrawal is used for non-qualified expenses, then the earnings portion of the withdrawal is subject to federal and perhaps state income tax. Also, in most cases, the earnings portion of withdrawals taken for non-qualified expenses are subject to a federal tax penalty of 10%, though there are some exceptions to the penalty. Contributions to a Coverdell ESA are made with after-tax dollars. These contributions are not tax deductible. Annual contributions to any Coverdell ESA are limited to a total of $2,000. Note that these $2,000 limits is per beneficiary, not per contributor. So if the same beneficiary is named on two accounts, the total contribution for the two accounts cannot exceed $2,000 per year. Contributions can be made until the beneficiary reaches age 18. There is a higher age limit for a special needs person. Lastly, there are income restrictions on those who can contribute to an ESA. The beneficiary of the Coverdell ESA, or his or her guardian, if the beneficiary is a minor, controls the account and can make withdrawals at any time. With the exception of a special needs beneficiary, any balance remaining in the account when the beneficiary reaches age 30 must be withdrawn. Balances can be transferred without tax penalties to another member of the beneficiary's family, who could be the spouse, child, grandchild, brother, sister, father, mother, etc. Let's talk a little bit about U.S. savings bonds, UGMAs and UTMAs. Some or all the interest earned on U.S. savings bonds may be excluded from income. The bonds must be qualified, which means that they must be Series AA bonds issued after 1989 or Series I bonds. Bonds must be issued in the name of the taxpayer, not the name of the person for whom education expenses have been paid. Qualified expenses include tuition and fees, but do not include room and board. Credit for using savings bond interest for education expenses is taken when you complete your federal income tax return. Accounts set up under the Uniform Gifts to Minors Act, UGMA, and the Uniform Transfer to Minors Act, UTMA, have been used for many years to pay for college education. One of the advantages they offer is that a portion of the earnings in these accounts may be either tax-free or taxed at the child's tax rate. Taxation is at the parent's tax rate until the child reaches age 18. One disadvantage is that once the child is no longer a minor, he or she controls the account and how the money is spent. Depending on the act and the state, one is no longer a minor between the ages of 18 and 25. UGMAs and UTMAs can be rolled over into Section 529 plans, but account control remains with the beneficiary once he or she is no longer a minor. Some financial planners suggest keeping a UGMA or UTMA if you already have one, spending down the account for the benefit of the minor, and opening a 529 plan for all new contributions. These savings vehicles can be complicated, however, so both from an estate planning and an education funding standpoint, be sure to consult a financial or tax advisor for more information about how to best use them and coordinate them with your 529 plan. Now let's talk about student aid and student loans. Once accepted to a college, you'll receive a financial aid offer letter that may include assistance from a variety of programs. Federal financial aid is available in the form of grants, work-study programs, and loans. Some of the loans do not have to be paid back if certain conditions are met. To apply for these programs, submit a free financial application to the Federal Student Aid FAFSA.gov application. The U.S. Department of Education offers the following loan programs. There are direct subsidized loans, which are loans made to eligible undergraduate students who demonstrate financial need to help cover the costs of higher education. Repayment typically must start within 6 months of graduation, leaving school, or going below half-time attendance. Then there are direct unsubsidized loans, which are loans made to eligible undergraduate, graduate, and professional students, but in this case, the student does not have to demonstrate financial need to be eligible for these loans. Next, Direct Plus loans are loans made to graduate or professional students and parents of dependent undergraduate students to help pay for education expenses not covered by other financial aid. There's also a Pell Grant and other types of federal student aid grants, which are available as direct aid based on exceptional financial need and the cost of attending college. Check out studentaid.gov for program details. Students can also benefit from state financial aid programs, and general information about these programs is available from the National Association of Student State Grant and Aid Programs. Don't forget about private assistance programs. Corporations, foundations, and communities offer scholarships, grants, and endowments to students. Many of them are not primarily based on financial need or academic achievement. Many colleges will also offer additional financial aid based on merit and need, so be sure to contact the school's financial aid office to see what other forms of aid may be available. And then there are also federal tax credits available to help pay for college expenses. The American Opportunity Credit provides a tax credit of $2,500 per year per student. It can be claimed for qualified higher education expenses for students in their first 4 years of post-secondary schooling. There are income limits able to be taken advantage of this credit. The Lifetime Learning Credit allows for tax credit of up to $2,000 per year per tax return. Credit can be claimed for qualified higher education expenses for students at any stage of their post-secondary education. And like the American Opportunity Credit, there are income limits in order to use this credit also. Be sure to check out the Internal Revenue Service's publications for more information. Next, let's take a look at student loans. We hear about news articles and reports discussing the loan debt that many students are accumulating in order to attend college. There are about 43 million student loan borrowers with outstanding student loans. The student loan debt is estimated to be $1.7 trillion in the United States. Student loans have a delinquency rate of about 11%, and each borrower has an average of $37,700 in student loan debt. Keep in mind that student loan debt doesn't just affect recent graduates. It can impact people over the course of their lifetime, in their 30s, 40s, 50s, and 60s. What are the options if someone is struggling to make their student loan payments? There are temporary solutions, which include asking the lender for a suspension, reduction, or an extension to pay. If there are multiple loans, another option is either a student loan refinancing or loan consolidation. Although the terms are often used interchangeably, these are two different things. To pay for college, you may have used a mix of loans from private lenders and loans from the federal government. The interest rate, balances, and terms for each of these loans may vary. Some of your loans may have variable rates while others have fixed rates. Student loan refinancing, which can be done by a private lender, including banks and credit unions, is designed to help you combine all of your student loans, federal and private, into a single, more affordable loan. The new refinance loan will have a brand new interest rate, which, if your credit is in good shape, could be lower. If you have federal loans and want to maintain the protection and other benefits that come with them, you have another option: consolidation. Federal loan consolidation involves combining all of your existing federal student loans into a single loan with the federal government. Unlike refinancing into a private loan, which allows you to refinance both federal and private loans, the federal government does not allow you to consolidate private loans. There's another key difference with consolidation: the interest rate, which will be a fixed rate, might not be lower. Rather, it'll be a weighted average of all the interest rates on your current federal loans. The U.S. Department of Education offers direct consolidation loans, and there's no application fee. Refinancing is also an option. To save money while consolidating is an alternative for maintaining federal loan benefits. The option that's right for you depends on several factors, including your goals, the types of loans you have, the current interest rates, whether or not you need federal benefits, and lastly, your creditworthiness and income. For many individuals, borrowing for college is a path to earning a degree that can spark a fulfilling career and financial security. But with all the talk of the student loan crisis, six-figure student loan debt, it's easy to wonder if borrowing for college is a good idea. Colleges and universities provide opportunities to earn a bachelor's degree in everything from computer science and biochemistry to painting and psychology. Some majors provide a clear, direct path to high-paying, widely available jobs. Others do not. Students need to do their own research to see which careers are most in demand and offer the best pay. Then decide if taking on the amount of student debt they're considering is worth it. At that point, they can determine which degrees and which schools offer the best return on investment. The federal government's Bureau of Labor Statistics publishes an annual occupational outlook handbook online. Anyone can consult this handbook to find the median pay and projected demand for workers in almost any occupation over the next 10 years at various levels of education. In summary, we've looked at a number of ways to save for college education expenses. We've talked about savings plans like Section 529 plans and Coverdell education savings accounts, all of which are very popular ways of saving for future college expenses. Then there's U.S. savings bonds. The interest there can be a way of paying for some college costs and getting an income tax break at the same time. UGMAs and UTMAs are long-standing legal arrangements that can be used to put aside money for a minor's college education. And there are options related to federal and state student grants and subsidies. Lastly, we've looked at federal tax credits that can help with higher education expenses. And then there's always student loans, which are a financial resource used by many. We hope you found this information to be helpful as you plan for college. It's an exciting time for students, parents, and extended family. If you'd like to learn more, please reach out to an ARIS financial consultant or also take advantage of our webinars, podcasts, and online resources to answer questions and guide you in your financial planning journey. If you'd like to contact me directly, my phone number is 773-462-8717, and I'd be happy to provide any additional information. Thank you for listening.